Hi, I'm Helen from Time2 Resources. In this video, I'm going to help you to understand liquidity ratios, including how to calculate them, what the results mean, and how to write about them in an examination. Liquidity is a measure of a business's ability to meet day-to-day expenses and short-term debts, for example, to pay wages or buy new raw materials. It's important to the survival of a business. It looks at the relationship between current assets and current liabilities on a statement of financial position, which can also be called a balance sheet. Current assets are items owned by a business that will be used within 1 year. These include inventory or stock, debtors or payables, cash at bank and cash in hand, or cash and cash equivalents. Current liabilities are items owed by a business that will be paid for within a year. These include creditors or receivables and overdrafts. Liquidity asks the question, if I turn all of my current assets into cash, will there be enough to cover my current liabilities? Businesses use liquidity ratios. One liquidity ratio is the current ratio. This is calculated using the formula current assets divided by current liabilities. Let's have a look at a numerical example. Elliott's is a national chain of bakeries. You can see here their current assets and their current liabilities. Why not pause the video whilst you try to calculate their current ratio? Let's have a look at the answer. You should have added the three current assets together to find a total current assets of 137 million. The current liabilities is 111 million. We divide 137 million by 111 million to calculate the current ratio is 1.23. We express this as 1.23 to 1. This means that Elliott's has £1.23 in current assets for every £1 that it owes. A second liquidity ratio is the acid test ratio, also known as the liquid asset ratio. This is calculated as current assets minus inventory divided by current liabilities, or liquid assets divided by current liabilities. This is commonly considered a tougher measure as inventory is not included in current assets. The reason for this is it is the hardest of the current assets to turn into cash quickly, and if a business does try to turn it into cash quickly, it is likely to be at a substantially reduced value. When we see businesses advertising liquidation sales, this is an attempt to turn their stock into cash quickly and may indicate liquidity problems. Let's look again at our numerical example of Elliott's, the national chain of bakeries. Why not pause the video now whilst you see if you can calculate the acid test ratio for Elliott's. You should have calculated 137 million minus 27 million divided by 111 million. This gives us the answer 0.99. We would express this as 0.99 to 1. This means that for every £1 that Elliott's has in current liabilities that it owes, it only has 0.99 in current assets, so it doesn't have enough current assets if we exclude inventory to cover its liabilities. In an examination, you may be asked to calculate ratios or you may be given them. It's important to practice writing analytical lines of argument which are also in context. Think about the nature of the business and of its inventory to help consider which method is the most appropriate. Our bakery had a high stock holding of 27 million, which is likely to be spread across a number of stores within the national chain as well as headquarters. This could include ingredients, branded packaging and bottled drinks. Let's consider how we would use this information to develop a line of argument. If a business had to repay its current liabilities quickly, it may be at risk of not being able to meet day-to-day expenses. This is a threat to the survival of the business. Elliott's has an acid test ratio of 0.99 to 1, meaning that it only has 99 pence in current assets, excluding inventory, for every £1 it owes. The acid test is an appropriate measure of liquidity for Elliott's, as it is unlikely to be able to sell off raw ingredients such as flour or branded packaging quickly. Therefore, if it had to raise finance to cover debts, it may have to sell off fixed assets such as ovens or premises. If this happens, it would no longer be able to match supply to demand. This would threaten the business's future. We could also add an evaluation or a judgment. For example, however, this is only a threat if creditors or banks are likely to call in debts at a short notice. In reality, a lot of large businesses survive with low liquidity ratios. Thank you for watching this video on understanding liquidity. Hopefully this will help you to analyse and apply in the examinations. If you haven't already done so, why not subscribe to the Time to Resources YouTube channel now?